Welcome to the Deep Dive. Today we're tackling a really fundamental topic, iron ore. It's the absolute bedrock of the modern economy.
It really is. Dense stuff, essential, cornerstone of pretty much everything industrial.
Right. Fuels, infrastructure, construction, manufacturing. What is it? Something like 98% of all the iron ore mined goes straight into making steel.
That's the number. Steelmaking is its destiny, overwhelmingly.
But here's the thing. This huge global market, we're talking $290 billion. It's navigating what feels like a really crucial turning point right now. This isn't just your standard market cycle, the usual ups and downs. It feels different, defined by some pretty extreme price volatility and deep structural challenges underneath.
Yeah, I agree. What happens here, I think, in the next few months especially, it's going to have major ripples globally. Trade balances, industrial power. It's all connected.
So our mission today, for you listening, is to cut through some of that noise.
Exactly. We want to move beyond just the simple supply and demand charts, though we'll touch on those.
We want you to walk away with a really thorough understanding of the forces shaping this market in 2025.
Right. We need to grasp the geopolitical games being played, the environmental pressures building up, and the big strategic shifts. The things that are really challenging that old order.
You mean the era where basically a handful of giant mining companies just told everyone what the price was?
Pretty much, yeah. That era seems to be changing fast.
Okay, so we've spent the last week really immersing ourselves in the latest reports, analyst forecasts, breakdowns of resource diplomacy, focusing specifically on that 2025 outlook.
Producer strategies, the fight for pricing control. It's all in there.
We got a lot of ground to cover. Okay, let's unpack this. So the story of iron ore prices lately. It's been kind of dizzying, right? We really have to start with that price roller coaster. I think it tells you almost everything about the current instability.
Oh, absolutely. A wild ride is putting it mildly. If you think back just a few years ago, that post-pandemic stimulus, all the Chinese infrastructure spending.
Yeah, prices went nuts.
Totally nuts. July 2021, the peak hit $219.77 a pose per ton for the big miner, BHP, Rio, Vale. Those were incredible days. Margins were just immense, like printing money.
And it's safe to say those days are definitely over now.
Oh, yeah. Long gone.
The sources we looked at as of August 2025 put the price down around $101.42 a ton. That's a massive, massive correction.
It really shows you the slowdown in those global stimulus engines and, crucially, the weakness that's crept into construction demand.
But here's where it gets interesting and maybe a bit weird. What happened after that crash?
Right. You'd expect it to just keep falling, maybe? But it hasn't. Not really.
It's held surprisingly steady in a pretty tight range, actually. What was it? Between $96 and $110 per ton since late 2024.
Exactly. Even with all the geopolitical noise, the long-term demand worries, that price floor has been quite resilient. Analysts, they thought it might drop into the low $80. Hasn't happened.
That resilience is the irony, isn't it? So why the floor? What's stopping it from tumbling further right now?
Well, one key short-term driver, and this surprised a few people, was actually an improvement in investor sentiment, kind of driven by macro geopolitical stuff.
Like what?
The sources point specifically to tariff reductions between major economies. The U.S. and China easing off a bit. When those trade barriers come down, even if they aren't directly on ore, it signals better global trade conditions, more confidence in manufacturing.
Wait, hang on. Is that really strong enough? U.S.-China tariffs ease on, say, consumer goods, and that props up iron ore. Are we sure it isn't just, the big players managing their supply carefully, maybe hiding some inventory?
That's a fair point, a fair challenge. The mechanism they suggest is sort of twofold. First, better trade conditions mean less fear of protectionism, so maybe companies plan ahead more for manufacturing, build more ships, order more equipment, all uses steel.
Okay, a general confidence boost.
Yeah. And second, maybe more directly, lower tariffs can sometimes reduce input costs for steelmakers downstream in various places, frees up a bit of capital, maybe encourages them to bump up production slightly, buy a bit more ore in the short term.
So it's like a stabilizing effect, a confidence boost, but maybe not. Not a sign that underlying demand is roaring back.
Precisely. More of a psychological anchor than a reflection of booming fundamental demand.
Okay, that makes more sense. Now, we have to talk about the elephant in the room. The absolute behemoth.
Asian.
Always China.
Yeah.
Foundational. Still importing over 70% of all the seaborne iron ore in the world.
But even looking at their numbers, there's this paradox, right? Which really highlights how complex things are.
Definitely. Despite needing all that ore, their imports in the first quarter of 2025 actually declined year over year, down 7.8%.
Wow. In a normal market, a drop like that from your biggest customer, that would send prices through the floor.
You'd think so. But again, the price held relatively steady.
So no panic? Why didn't the market freak out when China cut back so significantly? Well, the analysis suggests the drop wasn't mainly seen as a signal of weak structural demand deep within China's economy.
Okay.
It was attributed more to temporary things, operational hiccups, supply disruptions. We saw some pretty bad weather, cyclones hitting key mining regions in Australia.
Oh, right. Australia is a massive supplier to China.
Huge. So those disruptions impacted shipments. The sources note that import numbers actually recovered pretty quickly once seasonal restocking kicked in. After the Chinese New Year, when construction activity usually picks up a bit.
Okay, so the market could tell the difference between a temporary logistics jam and a real long-term drop in appetite.
That seems to be the case. And we've even seen some small price rebounds recently back into that $102 range. Partly driven by speculation, actually.
Speculation on what?
On rising seasonal steel demand, particularly from manufacturing, maybe secondary industrial sectors. There's some cautious hope, maybe, that Beijing might introduce some targeted measures, not necessarily for new building projects, but maybe policies to help the steel sector's overall profitability.
Interesting. So if the steel mills themselves are healthier financially.
Right. Better balance sheets, maybe they can afford to pay a bit more for their ore. But, and this is crucial, we have to stress, demand for construction steel, rebar for new buildings, that is still persistently weak. And that's the big long-term drag on the market.
Yeah, that cautious optimism kind of evaporates when you zoom out and look at the fundamental reality in China. That stability we talked about, it feels pretty brittle if the main engine, the core demand driver, is basically stagnant. Let's dig into that stagnation. The weight of weak Chinese demand. What does that look like?
It really comes down to the production plateau. China's crude steel output, it's basically flatlined. Yeah. Around 1 billion tons a year for the last 5 years or so.
And iron ore demand comes directly from steel production. So if steel isn't growing,
demand for new ore stagnates or even shrinks slightly. And that had real consequences last year. Remember, in 2024, iron ore was the worst performing industrial metal. Prices were down, over 20% year to date by November? Just hammered.
And we keep circling back to the property sector in China. How direct is that link? How much does it matter?
Oh, it's huge. Immensely direct and politically sensitive, too. Historically, property construction consumes something like 40% of China's iron ore.
40%? Wow.
Yeah. So the ongoing weakness there, the massive developer debt, the lack of market confidence, that's the key structural break on demand. New home starts, down over 20% year to date. And crucially, government policy seems to have shifted.
Shifted how?
Instead of trying to stimulate lots of new building, the focus now seems to be more on easing mortgage terms, encouraging the sale of existing empty apartments, maybe even government buying some of that unsold inventory.
So even if those stimulus measures work, if they're just clearing the backlog of empty flats, they don't actually create new orders for rebar. No new steel needed.
Exactly. Zero new demand for iron ore from that specific angle. The goal seems to be more about achieving stability, managing the debt crisis, not necessarily firing up heavy industry again.
Okay, so that structural reality, that plateau, sets the stage for what you called, I think, the most dramatic strategic shift, the fight over pricing power.
Absolutely. I think this is fascinating. It's like a David versus Goliath situation, only David decided to form a union.
Okay, explain the history here, the imbalance.
It was pretty staggering for decades. Some analysts even called it the miner's monopoly premium. China importing 70% of the world's seaborne ore, the biggest buyer by far, yet they had almost zero negotiating power.
They just had to take the price offered?
Basically, yeah. Forced to accept terms set by the big three miners, BHP, Rio Tinto, Vale, they called the shots.
And the profit gap during those peak price years must have been astronomical.
Unsustainable from Beijing's perspective. Think about that 2020-21 peak again. Prices over $267 a ton, yet the sources confirm the actual cost for the big Australian miners to dig it up and ship it out, especially from the super efficient Pilbara region. Maybe around $10 a ton.
$10 cost, $267 selling price?
A 96% profit margin, roughly. Meanwhile, the Chinese steel mills buying that ore, they were often operating on razor-thin margins. Sometimes reports said as low as 29 yuan, maybe $4 or $5 per ton of steel produced. That huge transfer of wealth, that pricing rick pushed onto the buyer, China wasn't going to tolerate that forever.
So they needed to centralize. to fight back as one. And that led to the China Mineral Resources Group, the CMRG.
Exactly. Launched in 2022. A state-backed agency specifically created to unify the purchasing power of China's, over 600 different steelmakers?
Before CMRG, those 600 mills were basically competing against each other for ore supplies.
Right. Often driving the price up against themselves. CMRG changed that dynamic completely, almost overnight. Turned China into effectively a single, unified sewer buyer.
Wow, that must have totally changed the atmosphere at the negotiating table. Instead of hundreds of small contracts, the big three miners now face one entity representing 70% of their entire market.
It's arguably one of the most potent strategic responses to commodity supplier dominance we've seen in decades. And just recently, in 2025, the CMRG finally flexed that muscle in a very targeted showdown with BHP.
Okay, let's get into that specific confrontation. It started over quality, right, but became something much bigger.
Yeah, the spark was metallurgical quality. Seems as BHP's older Australian mines, particularly some in the Pilbara, started to mature, the quality of ore from specific projects like Jimblebar Fines allegedly dipped a bit.
Lower grade means more impurities, harder to process.
Exactly. Higher levels of things like silica makes it less efficient for Chinese steel mills, increases their processing costs. So China, through CMRG presumably, demanded a discount to reflect that lower quality. BHP refused.
And BHP didn't just refuse, they pushed back hard, still thinking they held all the cards.
It seems so. They didn't just reject the discount, they tried to impose a new long-term contract.
Yeah.
And it had two really contentious clauses baked in. A 15% price increase, despite the quality concerns, and a requirement that settlement happen exclusively in US dollars.
Wow. So demanding more money for arguably lower quality and insisting on the dollar, that's bold.
Very bold. Beijing rejected both terms flat out.
And that's when CMRG made his move. You called it tactical, surgical.
It really was quite clever, designed to make a strong point without causing massive economic disruption to China itself. So in September 2025, CMRG didn't announce a total ban on all BHP ore. That would have hurt Chinese industry too much.
Right.
Instead, they ordered Chinese steel mills to suspend all purchases of BHP iron ore that were denominated in US dollars. And they specifically targeted shipments coming from that disputed Jimblebar mine.
So hitting the specific product, the specific mine, and the currency all in one go.
A perfectly calibrated shot across the bow, it sent a crystal clear signal. China will no longer just passively accept terms dictated by the majors. And, maybe more critically, it directly linked a commercial dispute over ore quality to the bigger geopolitical goal of chipping away at the US dollar's dominance in commodities.
A demonstration that the super buyer wasn't just theoretical, it had real teeth.
Exactly.
Okay, but that tactical move against BHP, that suspension, it only really works if China has other options, right?
Okay.
The whole CMRG strategy kind of depends on not being reliant on just one or two suppliers.
Absolutely spot on. If China didn't have viable alternatives already lined up or coming online soon, that ban would have been toothless. They would have had to back down fast. And this points to the second huge strategic shift: China's relentless drive to diversify its supply chain.
Because the biggest long-term threat to the current market structure isn't really China's demand weakness, is it? It's the arrival of massive new supply from somewhere else.
That's the looming shadow. And we're talking, of course, about Simandou in Guinea.
Simandou. Yeah, that name must send a shiver down the spine of every mining executive in Western Australia.
It's the potential supply shock the market's been anticipating for years. It represents one of the world's largest, richest, untapped iron ore deposits. Huge resource, exceptional quality.
And it's a joint venture involving Rio Tinto, but also major Chinese state-owned companies, right?
Mm-hmm.
Like China Baowu.
Yes, significant Chinese involvement. And things are finally moving. Trial production apparently began in September 2025. The first commercial shipments, expected possibly as early as November 2025.
Let's try and grasp the scale here. 120 million tons annually. That sounds like a huge number, but put it in context for us. How transformative is that?
Okay, full ramp up, which they're aiming for by 2026 or maybe a bit later, is targeting 120 million tons per year. The total global seaborne iron ore market is roughly 1.5 billion tons.
So 120 million is like 8% of the total market, just from this one new source.
Exactly. Introducing that much new, high-grade ore fundamentally reshuffles the deck. It creates a massive third global supply hub, directly challenging the long-held dominance of Western Australia and Brazil. It will inevitably put downward pressure on benchmark prices in the long run.
Even if maybe in the short term, it helps stabilize prices by just being there as an alternative for China.
Potentially, yeah. It reduces reliance, but the sheer volume entering the market is the bigger long-term story.
Now, Simandou has always been plagued by massive political risk, huge logistical hurdles, building railways, ports, and difficult terrain. Are those concerns finally fading?
Actually, no. The sources suggest political risk in Guinea might even be rising. The current military-led government has taken a more interventionist stance lately.
How so?
Well, they recently revoked something like 129 mineral exploration permits from various international companies. That kind of action makes investors very nervous about stability, about whether contracts will be honored.
And it raises questions about those huge infrastructure timelines. Building 650 kilometers of railway, a new deep water port.
Absolutely. Can those timelines be maintained if the government keeps intervening? It introduces uncertainty. Resource nationalism is always a risk, and it could definitely delay that full 120 million ton ramp up well past 2026.
Okay, so Simandou is the big future anchor, maybe. But China isn't just waiting for that. They're also actively strengthening ties with existing partners, like Vale in Brazil.
Yes, that's the parallel track. The second front in their diversification strategy, they're deepening cooperation with Vale, including direct Chinese investment in infrastructure projects in Brazil.
Aimed at making Brazilian ore cheaper and easier to get.
Precisely. Things like funding for the Qinghai port facility, plans for transcontinental rail links. It's all about reducing the logistics costs for Brazilian ore, making it more competitive, more reliable, further reducing China's vulnerability to any issues, political or otherwise, coming out of Australia.
And this fits perfectly with the tactical move against BHP's dollar demand. The action against the USD settlement wasn't just about that one contract. It's part of China's bigger game plan.
It absolutely is. The broader, long-term geopolitical objective of promoting the yuan, the RMB, in international trade.
Eroding the dollar's dominance in commodities.
Correct. Rejecting BHP's dollar terms was a very deliberate move to accelerate that. And it's not just symbolic talk, it's working. The sources say already 28% of the iron ore trade between China and Brazil is being settled in RMB.
28%, that's significant.
It is, and apparently multiple African suppliers who are often keen for Chinese investment are also now accepting RMB payments for their raw materials.
It shows this is becoming commercial reality, not just political posturing. Even the traditional giants have to adapt.
They really have no choice if they want continued access to the world's biggest market. And perhaps the most telling sign, BHP itself has reportedly conceded ground, agreed to settle 30% of its own trade with China in yuan.
Wow. Even BHP, that's a huge symbolic shift, even if the dollar still dominates overall.
It signals a major change in the power dynamic in commodity finance. It acknowledges China's leverage as that unified superbuyer.
Okay, let's quickly circle back to the immediate supply situation. You mentioned earlier that the initial fears of a huge oversupply in 2025 have eased off a bit. How bad was the initial forecast and why the revision?
Yeah, the initial threat looked pretty serious. Early forecasts suggested an iron ore surplus for 2025 of maybe 50 million tons.
Right.
A surplus that big would usually mean sustained low prices.
Okay.
But those forecasts have been revised down, now closer to maybe a 20 to 30 million ton surplus.
Still a surplus, but much smaller. What changed?
Two main things, it seems. First, those supply disruptions we talked about, the Australian cyclones, for example, took more ore out of the system than initially expected, kind of put a natural brake on supply buildup.
Okay.
And second, surprisingly strong global steel demand, particularly driven by exports. It seems global buyers, maybe worried about future trade barriers or tariffs, rushed to secure steel supplies. That led to higher than expected steel production, especially in China, soaking up some of that ore.
So a temporary buoyancy that kept prices from falling below that crucial $95, $96 level.
That seems to be the dynamic. And looking a bit further out, there's a view that demand will remain reasonably resilient anyway, regardless of short-term surpluses.
Why is that?
Because China's fleet of blast furnaces, the core of their steel industry, is actually relatively young. Most were built in the last decade or so.
So they're built to run for a long time still.
Exactly. These are massive, capital-intensive facilities. They need consistent, high-volume iron ore input to run efficiently. They're economically viable for probably the next 10, maybe 15 years. So that underlying infrastructural reality provides a sort of base level of demand, structurally firm demand, even if the explosive growth years are over.
Okay, so we have the price volatility, the China demand puzzle, the rise of the super buyer, the new supply threats. But underneath all that, there's another huge shift happening, right? driven by climate change necessity, the move towards green steel.
Yes. This is the quiet revolution that could fundamentally redraw the map for iron ore products. The steel industry is a massive CO2 emitter, one of the biggest globally. And the pressure to decarbonize is just immense now, coming from regulations, from investors, from consumers.
And things like Europe's carbon border adjustment mechanism. CBAM, that's a concrete example.
A huge one. Explain CBAM quickly for listeners who haven't tracked it closely.
Okay, basically CBAM is a mechanism to put a carbon price on certain goods imported into the EU, including steel.
Right. So in practice, if a steel maker, say in China, uses cheap high-carbon coal to process lower-grade iron ore, the steel they produce will face a hefty carbon tax when it tries to enter the European market.
Which forces steel makers, especially in Europe and Japan, who face these pressures most directly, to prioritize lower-emission production methods.
Exactly. And that, in turn, forces them to prioritize different kinds of raw materials. Higher quality, lower impurity inputs become much more valuable.
So the economics of the traditional coal-fired blast furnace are being directly challenged by carbon pricing. What are the cleaner technologies taking over, and what do they need?
We're seeing a clear pivot in two main directions. First, towards electric arc furnaces, EAFs. These primarily use recycled steel scrap, but also need something called direct reduced iron, or DRI.
Okay, EAFs. And the second path?
The second, maybe more radical long-term path is hydrogen-based DRI production. This is being pioneered mainly in Europe and Japan. The idea is to use green hydrogen instead of natural gas or coal as the reducing agent, which could potentially eliminate CO2 emissions almost entirely from the iron-making process.
Right. This is where we need to understand the technical link. Why does this shift to EAFs and especially DRI totally change what kind of iron ore you need? What is DRI and why is high-grade ore suddenly so critical?
Okay, so direct reduced iron, DRI, is made by processing iron ore in a solid state. You use a reducing gas, traditionally natural gas, but potentially hydrogen in the future, to remove the oxygen, creating this highly metallic sponge iron. Now, traditional blast furnaces, they use massive amounts of heat from burning coke, and they use fluxing agents to melt everything down and separate out impurities like silica and alumina as liquid slag. They can handle ores with more impurities.
Or more forgiving.
Much more forgiving. DRI processes, however, operate at lower temperatures and don't have that slagging mechanism in the same way. Impurities in the ore tend to stay with the iron. This means they require much, much purer iron ore feed. Typically, iron oxide pellets or lump ore with very high iron content, often needing Fe levels above 67%, maybe even 68%, and very low levels of silica and other contaminants.
And the standard benchmark ore, say from Australia's Pilbara, that's usually around 62% Fe, right?
Exactly. That 62% Fe ore is perfect, cost-effective feed for traditional blast furnaces. But for DRI producers, using that lower-grade ore significantly increases their energy consumption, reduces productivity, and complicates the process. It adds cost and difficulty.
So the world is effectively splitting into two distinct iron ore markets.
That's how it looks. A large, probably oversupplied market for the standard lower-grade blast furnace feed, and a separate, growing, and likely much tighter market commanding significant price premiums for the high-grade ores and specialized DR pellets needed for these new green steel pathways.
And Europe is really leading the charge on building this new DRI capacity.
They are, largely driven by regulation like CBAM. Projections suggest Europe's DRI production capacity could hit nearly 40 million tons by 2035. That's a massive concrete shift in the type of raw material they'll be demanding.
Which means the demand and the price premium for that high-grade ore is only going to increase, almost regardless of what the benchmark 62% price does.
That seems inevitable. Quality premiums are set to widen significantly.
This brings us right back to Simandou in Guinea. That project seems almost perfectly timed, doesn't it? Its main advantage is its quality.
That's its killer app, strategically speaking. The Simandou deposits are naturally very high-grade, high iron content, low impurities. That makes the ore ideally suited for the decarbonizing market, for DRI production, for the hydrogen future.
So it directly challenges the traditional suppliers, like those in the Pilbara, not just on volume, but now critically on quality.
Absolutely. Quality is becoming the new competitive battleground, maybe even more so than just cost per ton for the benchmark grade.
So those traditional suppliers, the big Australian miners, they have to react. They can't just keep shipping the same old stuff.
They have to adapt their product mix and their marketing strategies even before Simandou hits full stride. They risk being relegated to the lower margin segment of the market if they don't.
How are they adapting?
We're seeing blending strategies emerge. Rio Tinto, for example, which is also involved in Simandou, is reportedly planning to blend the ultra-high-grade ore from Guinea with its existing lower-grade Pilbara supply, probably at Chinese ports.
Why blend? To lift the average quality.
Exactly. It makes their overall offering more attractive to modern mills that need better quality feed, potentially justifying a better average price. Vale, in Brazil, is also apparently doing sophisticated blending of different ore types, including managing high silica ores right at Chinese ports to meet specific customer needs and optimize their own cost structures. So you put it all together. The softer benchmark prices for standard ore, the looming threat of new high-quality supply from Simandou, China's pushback on pricing via CMRG, it's all taken a very clear, very measurable financial toll on the world's biggest mining companies.
Yeah, the profit numbers really show that the easy money days are gone, even for the most efficient producers out there.
Look at BHP's results. For their fiscal year 2025, they reported a 26% drop in underlying profit, down to about US $10.16 billion. That was their lowest profit figure in 5 years.
26% drop in profit. What drove that?
Overwhelmingly, it was the lower iron ore price. The average price they actually received for their ore fell by 19% over that period.
Okay, wait. A 19% fall in price led to a 26% fall in profit. That seems disproportionate.
That highlights the intense operational leverage in mining. These are businesses with huge fixed costs maintaining the mines, the railways, the ports, the workforce.
Right, those costs don't just disappear when the price drops.
Exactly. So when your revenue falls sharply due to lower prices, but your costs stay relatively constant, the impact on your profit margin gets magnified. That's operational leverage. And the other majors felt it too. Vale reported a 22% drop in their EBITDA. Rio Tinto's EBITDA fell 19%. This kind of financial pain forces companies to rethink their strategy.
Let's look at BHP's strategic pivot then, because it seems like a clear signal of where the whole sector might be heading. Even though they're still one of the lowest cost producers out there, their costs are incredibly low, around $17.29 a ton apparently. Gives them a huge buffer.
Even with that buffer, they're making significant changes, demonstrating real strategic caution. They've announced they're capping their iron ore output from the Pilbara region at 305 million tons per year.
Capping output, even as a low-cost leader. That signals they're worried about flooding an already weak market.
That's the message it sends. Instead of just pushing for more volume, which might depress prices further, they're aggressively shifting their investment focus towards what they call future-facing commodities.
Which means copper and potash mainly.
Primarily, yes. Copper is absolutely essential for electrification, the whole energy transition, electric vehicles, huge projected demand growth. And potash is vital for fertilizer, for global food security, boosting agricultural yields.
So BHP is pouring money into big new copper and potash projects instead of just expanding iron ore. Where are these projects?
Across South America, Chile, Argentina, and also in Canada, big long-life assets. And this strategic shift is already showing up in their earnings mix. Copper now apparently contributes 45% of BHP's underlying earnings. It's nearly caught up to iron ore, which is around 53%.
Wow, that's a major realignment, moving away from relying so heavily on iron ore.
It's about managing volatility, diversifying into minerals they believe have stronger, less cyclical growth stories tied to global mega trends like decarbonization and population growth.
So while the financial pain is definitely real for the majors, this environment, the oversupply, the price pressure, it probably also means curtains for smaller, higher-cost iron ore producers, right? Leading to more consolidation.
That's the likely outcome, yes. Survival of the fittest, or perhaps the lowest cost. Persistent low prices will squeeze the margins of higher-cost mines, potentially forcing closures or acquisitions. This would further consolidate the market around the big, low-cost players like BHP, Rio, and Vale.
But even those giants now realize they can't just ride the iron ore wave indefinitely. They have to pivot.
They have to diversify and adapt to the changing landscape, absolutely, towards critical minerals, towards higher quality products.
Okay, let's try and synthesize the outlook for 2025 then, for you listening. What's the short-term picture look like?
Short-term, prices likely stay under pressure. You've got two main headwinds blowing, that ongoing weakness in Chinese construction demand, and the anticipated arrival of significant new supply, particularly from Simandou, hitting the market perhaps as early as November. So market sentiment probably stays pretty cautious until there are clearer signs of structural demand improving.
Okay, and looking further out, medium to long term. Where does the momentum lie?
The momentum shifts decisively towards quality and decarbonization. That structural change driven by green steel technologies, the EAFs, the DRI processes is going to increasingly boost demand, and crucially, the price premiums for high-grade ore.
So
Strategically, the low-cost producers are still well-positioned, especially those like BHP, who are actively diversifying their portfolios away from just iron ore and are investing in accessing or producing higher-grade ore themselves. They'll be better placed to navigate the challenges of resource nationalism, shifting trade patterns, and the fundamental changes in what kind of ore the world actually needs over the next decade. #outro.
So let's just quickly bring those three big interconnected forces back into focus for you. First, you've got China, flexing its muscles as a unified superbuyer through the CMRG, pushing back on traditional pricing, demanding RMB settlement, really challenging the old ways.
Right. Force number one, buyer power.
Second, there's the looming reality of massive new supply, especially high-quality supply, coming online from diversified sources like Simandou and Guinea. That's fundamentally altering the supply-side structure.
Okay. Force number two, new supply competition. And third, underneath it all, is that huge structural shift towards green steel. Decarbonization is transforming the value proposition entirely, making iron ore quality not just sheer volume the critical factor.
Got it. Force number three, the green quality premium. Okay, so what does this all really mean at the end of the day?
Well, I think it means that the traditional iron ore market we knew, the one reliably dominated by just a few big suppliers setting the price in US dollars, often enjoying huge profit margins, that market is fundamentally over.
Control is shifting, or at least it's being contested much more fiercely.
Exactly. Control of this absolutely vital commodity is now much more contested. It's shared. It's dynamic. It requires constant, complex, tactical maneuvering from everyone involved, from the mine managers in Guinea or Brazil to the commodity traders in Singapore to the policymakers in Beijing.
And because the world relies so heavily on iron ore, it stays right at the center of huge strategic debates, doesn't it? About global trade, about sustainability, economic security.
Absolutely critical. Which leads us to a final thought, maybe something for you to ponder. We know these new technologies like hydrogen-based DRI are set to revolutionize steelmaking. So, the future competition. Maybe it won't just be about who can mine the cheapest ton of standard ore anymore. Maybe it's about who can deliver the greenest ore.
The highest quality, lowest impurity input, perfectly optimized for that net zero steel future.
Exactly. So the provocative question is, what do you think are the long-term geopolitical implications of this global quest for green steel? Will this shift towards needing premium green or ultimately swing the pricing power back towards the producers who happen to own those high-quality deposits? Or will the power stay firmly with the buyers, the steelmakers, who control the new production technologies and operate within the tightening regulatory environments that demand decarbonization? Where does the leverage ultimately lie in a green steel world?